When the market is down 20% and the stock is underperforming the market, the stock is down 40%, we need to ask ourselves if this stock is undervalued. Because many times what you will see is that when the market is going down, some of stocks are going further down compared to the rest of the market. But these are the stocks then that you should be buying, because you buy low and then you sell high. One of these stocks that we are going to look at today is Target, one of the largest retailers in the world. Before we talk about Target, please make sure to smash the like button for the YouTube algorithm. If you're new to the channel, my name is Ishfaaq. I am an elite popular investor on eToro. Please make sure to subscribe and to hit the notification bell so that you don't miss the coming videos. Target is the 7th largest retailer in America. Compared to other retailers such as Walmart, Costco, or even Kroger, they have a different business model. You will tell me that all of them, of course, are different. It's true, but they are different in different ways in that they are targeting different people. If you go to a Target store, you will see it is totally different compared to Walmart. It is more beautiful. I don't know any other way to describe it, but it looks more beautiful. It looks cleaner. So they are targeting people who want to go there. People who are not really trying to buy the cheapest things at Walmart, but they are trying to buy something which is affordable, but still they have a good service, a good time at Target. And if you look in 2019, places where people of different income went to shop, you will see that Target is targeting people with a higher income. People with less than $25,000 a year, people making less than $25,000 a year, you will see most of them are shopping at Walmart. Target is not where they're going to shop. They will also prefer to shop on Amazon or even at Kroger, but not Target. And then people who are making a lot of money, they would prefer Target or even Costco. Why Costco? Because in Costco they can buy in bulk, and usually if you want to buy in bulk, you should be buying with a lot of money. But Target is also there. You're not going to go at Target to buy in bulk. It's a place where you go, you have fun, you have a good time, but you know you're doing shopping. This is the difference between Target and other retailers. So how Target is able to maintain such a business? It's mostly through owning their own brands. They own so many brands, so they sell their own products, and these products are not available anywhere else. So when you go to shop at a Target, you're buying your groceries as usual, and then you have these brands that they sell. Of course, Walmart and other retailers, they try to sell their own brands, but they are cheaper quality. While Target, they try to give you a better quality, but it is still affordable. And you know, once you have bought this brand, you cannot buy it somewhere else. Let's say you bought some clothes, you like it, after 6 months you need to buy them again. You cannot go somewhere else to buy them. You won't be able to buy them on Amazon. You won't be able to go and buy them at Walmart or any other clothing retailer. You have to go back to Target, and when you go back to Target to buy your clothes, you will come back with other things that are made exclusively by Target. Of course, to maintain these higher quality services in their stores, cleaner stores, all of this, to maintain all of this, it costs a lot of money. So are they able to compete with the competitors? Actually, what they do is that the customers are going to pay the higher prices. They are not really going to pay for their cleaner stores. It's the customers who pay for the cleaner stores. You buy something at the Target, you buy it at the Walmart, you're going to buy it cheaper at Walmart compared to Target. But if you prefer to buy at Target for the cleaner space, for the wonderful time you're going to spend there, then maybe it is worth it for you. That's why we have seen in this chart that most of the people shopping at Target, they are not the people making less than $25,000 a month, but people with higher income. So this is the business of Target. And so far it has been working, because you will see that the revenues of Target over the long term has been growing. In 2020, 2021, we have seen a huge increase in revenues, but that's because of the pandemic, of everything that has been happening, inflation. It is not likely to continue like this, but still over the long term, I believe that Target revenues and consequently income, free cash flow, is going to keep increasing. So why the market is unhappy with Target? The market is unhappy because of the high inventories. One of the reasons, Target in recent quarters has been increasing their inventory a lot, and it is expected that maybe we'll see a recession. If there is a recession, they won't be able to sell all of this quickly enough. And inventory over time, you cannot just store it. Some of it will get damaged and some of it will expire. So gradually over the long term, because of this overbought oversized inventory that Target has right now, they're going to lose money because of this. So that's why the market is worried. But a 40% drop compared to a 20% drop of the market, has the market overreacted? I believe it has overreacted, but I'm not willing to buy Target. So why? Let's look at the numbers of Target. We already talked about the revenues. We said that Target revenues in the last 2 years has grown rapidly, but even over the long term, it is growing by, let's say, about 4 to 5% a year, which is good in my opinion. The company has maintained a good operating margin, good net income margin, and even good free cash flow margin. What can we expect now for the future of Target? This is for the last 5-6 years. What about the next 5 years? What should be expected? If we are going to see a recession in 2022 and 2023, then maybe the net income of the company will go down. Revenue to the company will still continue to increase because this is a retailer. People will still go shopping. But if we see inflation, if we see a recession, then normally what happens, it is reflected on the net income. And even if we see a recession because of the high inventory, it will be reflected on the net income. So what I have done, you can find everything on my research partnership. All my analysis, all my research are available on my research partnership. If you're interested, you can have a 1-month free trial. You can have also my investing course for beginners there. So for 2022 and 2023, because we're expecting recession, I have taken lower margins. So even if I'm expecting revenues to increase, let's say by 4% a year, which I've used there, the numbers, you will see it, then I have expected that maybe the margins will be lower in 2022 and 2023. Consequently, the free cash flow also will be lower. But for 2024, 2025, 2026, then we are getting back to normal figures. So this is for the income of the company. If we can have the free cash flow, the expected free cash flow, we can discount this to calculate the intrinsic value of the company. So how do we calculate the intrinsic value? We look at cash flow today, we look at cash flow in a year, cash flow in 2 years, cash flow in 5 years, all the cash flow that the company is going to produce in the future, and then we discount them. Why we discount them? Because money today has more value than money in the future. And how much should we discount this? We look at the discount rate. The discount rate we are going to use is related to the interest rate right now, because it's not really about inflation. When I'm saying that money today has more value than money in the future, it's not because of inflation, it's mostly because of alternatives. If, let's say, bond rates, treasury bond rates, the 10-year yield was at 15%, you would prefer to buy bonds instead of stocks because treasury bonds are safer compared to stocks. So you will prefer to buy bonds compared to stocks. Then you cannot use a discount rate of only 10%. You will need to use maybe 20% because you're putting more risk when buying stocks compared to bonds. So that's why we use a discount rate. Today the 10-year treasury yield is about 2.8%. So the discount rate we are going to use will be higher than that. How much higher? 5%, 6%, it depends on you. And also the discount rate, another way you look at it, that is the expected returns. I don't like to use anything below 9%. So for Target, I will use 10%. That 9%, I use it for Apple, for JP Morgan Chase, but I'm not going to use it for every company. So I'm using 10% for Target because you look at the balance sheet. How do you calculate the discount rate? You have to look at the balance sheet. You have to look at the company itself. It is stable. If it is stable company, then the risk will be lower. And you look at Target today, despite the things they have in their inventory, everything else looks good. They have a good balance sheet. They have their debt properly spread out over time, so they will be able to repay all these debt properly. So we should not be worried about the stability of Target, whether the company will go bankrupt or not. This is not something we should worry about. They have a powerful brand, so all of these are taken into consideration when we are calculating the discount rate to use. So the discount rate I have used is 10%, and then the terminal growth rate, that over the long term, after 5 years, the company will grow its free cash flow by 3%. So using this, we can calculate the intrinsic value of the company. And you will see it is about $70 billion. You look at the company, the market cap is around $70 billion. So it is fairly valued because we are not taking a margin of safety yet. We have to take a margin of safety. Let's say we take one of 15%, which is reasonable here. Then the value at which you are willing to buy the stock will be lower, which means it is not a buy today. So to conclude, I will say that Target is a great company. I would love to own this company, but unfortunately, it is not at the right price today. It's not really because I believe things will go bad for the company next year. It's not like that. The company was overvalued. If you ask me a few months ago, 6 months ago, it was overvalued. And even though it fell by 40%, it is not enough. It is fairly valued today. If it was further by 20%, then maybe I'm going to invest in Target, but not now. Right now, it is still fairly valued. It was overvalued, so even though a company crashed by 40%, it doesn't mean anything if the company was already expensive. That's why I'm telling you, even if Netflix, I don't know how much it crashed, for me it is still overvalued because it's not enough. So a company crashing by 80% doesn't mean anything if the company was overvalued and is still overvalued today. It doesn't matter how much it crashed. What matters is that how much it is worth right now. And looking at Target, it is fairly valued and I have to take a margin of safety. When I take it, it is not a stock I'm willing to buy right now. In the future, probably, maybe, I hope it keeps crashing and then I can buy this wonderful company because really it is a wonderful company. And compared to the competitors, I would rather buy Target compared to Walmart or other things. I like the business that they have. I have owned Target in the past, but I took profits. I think it was 2016. So now I'm not willing to buy it again, but maybe in the future it's going on my watch list. So let me know in the comments what do you think about Target. Thank you for watching this video. Please like, subscribe and share. Please watch these two videos if you missed them. Have a nice day and goodbye.